Yeah, so good evening together. We will present you today our presentation about investment banking, and we will start as usual with the table of contents. So we will in the beginning clarify the role of an investment bank. Then Philip will present you M&A, mergers and acquisition. Meda will talk about with you about equity capital markets. Kashina will talk with you about debt capital markets, and I will present financial restructuring and SPACs. So let's start with the role of an investment bank. So as you can see, an investment bank has a back office where we have the usual divisions like compliance, legal, HR, marketing departments, and risk management, and the front office. And the front office, as you can see, is divided into public markets and private markets. So let's look at the public markets, because this is sales and trading. And we want to now clarify what essentially investment banking is by definition. And therefore, I want you to get rid of the thought that investment banking is something like you saw on Wolf of Wall Street, because it's not. This is sales and trading. What really meant by the definition of investment banking is what happens here in the private markets. So debt capital markets, which is everything regarding with bonds and loans and ECM. So equity capital markets, here you will learn about IPOs, and the investment banking division M&A, so merger and acquisition. And what I also want to mention is that this line is called Chinese wall. This needs to be thick and secure. Yeah, it really needs to be safe because it's Chinese wall. Yeah, those two departments are not allowed to communicate with each other. If they do, this is known as insider trading, and of course this is not allowed. So they have here this Chinese wall. They are not allowed to communicate each other. Philip will present you now and go more in detail with you in the merchant acquisition process.
Thank you, Paul, for your introduction. So I will going to present you M&A, and first of all, I want to say that M&A is basically the purchase and the sale of companies, and you have to distinguish between mergers and acquisition. Many people think that these are the same things, but it isn't the case. And mergers is when companies of one or two or even more companies of similar size agree to integrate their operations into a single entity, and they are sharing the ownership, the control, and the profit. They unite the resources, strength, and weaknesses to remove trade barriers, lessen competition, gain synergy, and basically get more market share. On the other hand, you have acquisition. There's a company that is acquiring a target company, and in every case, the acquiring company is more powerful. And they can either do an asset or a share deal. An asset deal is a deal where you probably learned it in your accounting class, that there's the asset side, the active side in accounting, and the liability side and the passive side. And if you do an asset deal, you just buy the assets of the company, so the inventory and and if you do a share deal, you are buying the whole company, so the assets and the liabilities. So if you do a share deal, the new owner will keep the liabilities and get the assets. And if you do an asset deal, the new buyer just keep the assets and the liabilities. The owner who's going to be replaced, he keeps the responsibility of the liabilities. And you probably ask yourself, why should the buyer do a share deal, not an asset deal? And the reason for this is that the asset deal is judicially much more complicated, and it is much more expensive than a share deal. That is why a share deal is more often done than an asset deal. And an acquisition can be hostile or friendly. It is friendly if the management of the target company is agreeing to the acquisition of their company, and a hostile acquisition is if the target company, the management of it, says no to the idea of getting acquired. You probably ask yourself, how can they do this? How can they do a hostile acquisition? And there are three different ways to do it. And the first one is the tender offer. They are putting the management under pressure by making it public that they want to buy the target company. For example, if you have Microsoft and a little IT company with a net worth of $5 million, if Microsoft makes it public that they want to buy this company, all the shareholders want to make it work, because they gain more profit if Microsoft is going to buy this small company. So they are going to put the management under pressure. And the second way to do it is the proxy fight. In this case, the acquiring company is going to the biggest shareholders and tell them that they should convince the management, because the biggest shareholder usually have a big influence on the management of the company, and they tell them that they should convince the management to change their opinion. And the last possibility is the creeping tender offer. In this case, the acquiring company is buying as many shares as possible. They usually do this by sending, for example, an email to every shareholder and tell them, we are going to buy your share for a higher price than the actual value at the moment. And this is often done with an assumption of gaining a certain percentage of the share to not waste money for nothing, and get a certain percentage of the share to gain control over the target company. So here you can see the main differences between mergers and acquisition. Mergers means to combine, and there is a formation of a new company, and they decrease competition and increase operational efficiency, and there are more legal formalities. And on the acquisition side, that means to acquire. There's no new company made. They just gain the assets of the company for instantaneous growth, and they have less legal formalities. So here you can see the list of the biggest M&A deals. One of them, the biggest one, is the Vodafone and Mannesmann merger in 1999. It costs $202.8 billion for Vodafone to merge with Mannesmann. And as you can see on this chart, it is if you see any list of the biggest M&A deal, it is more usual that it is a merger and not an acquisition. And it is kind of simple to know it, because it is more likely that two big companies merge together than that a big company buys another big company, because they don't have the power to buy a big company as a big company. For example, Apple will never be able to buy Samsung. This is just impossible for them. That's why you have more mergers than acquisitions, and if you see the biggest M&A deals. So now I'm going to present you the process of an M&A deal. And you have to know that there's two sides in process of an M&A deal, the sell side and the buy side. This is really similar to a real estate agent, where the real estate agent is the sell side who is going to sell the property, and there's many buyers who have the money and the capital to buy this to buy this property. And in this case, the sell side is responsible for creating or issuing financial securities. And there's the investment bank that sells financial products to the buy side, the commercial bank that take deposits and lend money to the public, stockbrokers, traders, and market makers. these are the people who are, as Paul already mentioned, in the sales and trading division in investment banking, and they are creating market opportunities and selling financial securities to the buy side. And on the buy side, you have, for example, companies who has the money to buy the assets, or asset management firms, hedge funds, private equity firms, venture capital firms, and private wealth management. So now we're going to the actual process of an M&A deal. There are three main phases. The first phase is a pre-merger sale, the second phase is a merger negotiation, and the last phase is a post-merger phase. First of all, before the first phase starts, it is always the case that if a company wants to sell themselves, to sell the company, they're going to different investment banks to get some offers from the investment banks to look which investment bank they want to be advised of, and the investment bankers want to win the deal by pitching for business and working on pitch decks. That's something you usually do as investment bank junior. If you're starting an investment bank, you're most likely to do something like that. And after you won the deal, you're doing due diligence. And in this part, you call on lawyers, auditors, and consultants to make sure that everything is legal there, so that the owner of the business who is going to sell it, that he has the right to sell the financial securities, that he really owns the properties, and they're doing this to prevent fraud. And this can take weeks to months to do this. And this is important for especially three stakeholders. The first one is the buyer. He needs to be sure that he's buying a function of business and that they get what they sign. And of course, the second one is the seller. He needs to do due diligence on the buyer because he needs to know if he can really afford to pay. And the third one are the financiers, and they needs to diligence on the buyer. Because if he raise debt or get leverage in order to buy this company, they need to know that they're buying a company that is working, and they need to know if they have enough money to keep up with the repayment and to pay back the principals. And the investment banks are drafting a much more comprehensive and detailed version of the financial modules of the company that is going to be sold, and they are presenting them to the potential buyers. After that, they're creating a tier 1 list and a tier 2 list. In the tier 1 list contains the most likely buyers that will buy the company, and the tier list 2 is going to contain the other companies who are potential buyers. And you have to distinguish on the buy side between strategic companies and financial companies. Strategic companies are companies who wants to buy or merge with a company being sold for synergy and they basically have the same interests as the company that is being sold. And on the other side, there are financial companies, such as private equity firms. And it is most likely that financial companies are going to get the deal because they are always in a rush to buy it, because private equity firms, they're gaining profit in buying companies and selling them again and getting more profit. And strategic companies have to do more due diligence to find out if it's really worth to do it, and they have to do much more restructuring in their company to merge with another company. But the problem with financial companies is, especially private equity firms, that they're going to rip apart your financial valuation because they want to save money and justify their low prices with that. But if everything is done, if they want to keep on with the process, and they've found a potential buyer, they have to sign an NDA, a non-disclosure agreement, to keep negotiation and information secret. That's what Paul mentioned at the beginning. There's this Chinese wall, and nobody should know about it if one company is going to merge with another or buy another, that the stock market won't be manipulated by that. And as I said, they keep the negotiation and information secret, and after that they're getting more details on the specifier of the company to be confident in proceeding the process. After that, there's the phase 2, the merger negotiation. Here are the financial modules presented by the buy and sell side, and they are doing a back and forth request to get an agreement on a price. So you probably think the highest price is the one that is going to be taken, but this is not the case. It's usually the case. It depends on the payment method, because it is not really most of the companies are not able to pay $202.8 billion in cash, so they probably do it partially, and it depends on the payment method. And if you want to work as an investment banker and as an investment banking junior, you are not accompany the client throughout the whole process. You're just accompany him through the first phase and part of the second phase, because just the manager director is accompanied with the client throughout the whole process. And the last phase is the post-merger phase. In this phase, there are the payouts, meetings for talks about the merger in general, and it's basically putting the deal together and wrapping up the company and merge them. And there are appearing many issues. One of them you also have to mention in the first phase are the regulations. Regulations are there to protect the market from monopolies. And there you just have to take care that you do not merge with another big company to get more 50% of the market share, something to get a monopoly. And that's something that needs to be prevented and needs to be kept in mind. And another issues, especially if you merge or acquire a company from a different country, are, for example, currency fluctuation, especially in countries where the currency is unstable, or political instability, that they're establishing always new taxes, new regulations. Cultural norms can be different, so you have to accept them, know them, and adapt to them. And and the most important part is the taxation. As an investment banker, you always have to find the most tax-efficient deal you can find. And besides of the cultural things, if you buy a company from your own country, there are many differences, especially in the combining of two companies. The merge of it is really complicated. There's lots of internal governance need to be done, internal restructuring that's going to take place in order to combine the two companies. And the biggest issue is the threat of redundancies. So you can imagine if you have two companies, both of them have a head office, for example, and if they merge together, they need to create just one head office. And it happens really often that some of them are going to be kicked out, and this in turn can lead to loss of key individuals, failure to extract synergy, and in the worst case, they lose value and get a target company for acquiring companies. But if there's no issues anymore, if everything is done, they can finish the deal, and that is everything that happens in a process of an M&A deal. So the last thing I wanted to talk about with you are the career opportunities that may be really interesting for you. There are career opportunities on the sell side and on the buy side. On the sell side, you have the investment banking division. In this case, you are being involved in M&A, DCM, ECM, and corporate finance. There's also the sales and trading floor in the investment bank. So there you buy and sell financial securities to the buy side. And the research, where you analyze public information to advise investors. And on the buy side, you have private wealth management, asset management. There you are managing wealthy individuals' capital and invested. You are working for hedge funds, private equity, and venture capital firms. So you, as you probably know from my presentation now, the sell side and the buy side careers are similar. They have many communications, and one of them is compliance, risk operations, technology, finance, and HR. These are in both of them.
Thank you, Philip. And now today I will give a little insight of the capital market and also the equity capital market, short form for ECM. What is the capital market? The capital market is a market where buyers and sellers engage in trade of financial securities like bonds, stocks. The buying or selling is undertaken by participants such as individuals and institutions. Now let's move on. The capital market can be further divided into two parts, the primary market and the secondary market. The primary market is a new issue market. Also known, it solely deals with the issue of new securities, also known as IPOs. The main objective is capital formation for government institutions and companies. The secondary market is a place where trading takes place for existing securities. It is known as stock exchange or stock market. Here, the securities are bought and sold by the investors. Now let's move on to the ECM. The equity capital market. The equity capital market is a subset of the broader capital market where financial institutions and companies interact to trade financial instruments and raise capital for companies. Equity capital markets are riskier than debt capital markets and thus also provide potentially higher returns. Equity capital market is raised by selling a part of a right to a company's asset in exchange for money. Thus, the value of the company's current assets and business define the value of its equity capital. The instruments that are traded on the equity capital markets are common shares, preferred shares, private equity, ADRs and GDRs. Common stocks. Common stock shares represent ownership capital, and holders of common shares are paid dividends out of the company's profit. Common shareholders have a residual claim to the company's income and asset. Preferred shares. Preferred shares are a hybrid security because they combine some features of debentures and common equity stock. They are like debentures because they have a fixed rate of dividends and have a claim to the company's income and asset. Private equity. Equity investment made through private placement are known as private equity. Private equity is raised by private limited enterprises and partnerships as they cannot trade their shares publicly. ADRs, that is American Depository Receipts, is a certificate of ownership issued in the name of a foreign company by an American bank against the foreign shares deposited in the bank by the said foreign company. The certificates are tradable and represent ownership of shares in a foreign company. GDRs, Global Depository Receipts, are negotiable receipts that are issued against the shares of foreign companies by financial institutions situated in developed countries. Next slide. The equity capital market acts as a platform for the following functions: marketing issues, distribution of issues, allocating new issues, IPOs, private placement, trading derivatives, accelerated book building. Next. The equity capital market can be divided into two parts, the primary equity market and the secondary equity market. The primary equity market allows companies to raise capital from the market for the first time. It is further divided into two parts, private placement market, primary public market. The private placement market allows companies to raise private equity through unquoted shares. It provides a platform where companies can sell their securities to investors directly. Typically, the private placement market is liquid and risky. The primary public market deals with two activities, IPOs. An IPO refers to the process by which a company issues equity publicly for the first time and becomes listed on the stock exchange. Secondly, we have SEOs, secondary public offering. An SPO is the process by which a company that is already listed on the stock exchange issues new or additional equity. Now let's see secondary equity market. The secondary equity market provides a platform for the sale and purchase of existing shares. No new capital is created in the secondary equity market. The holder of the security and not the issuer of the trade security receive proceeds from the sale of the security in question. The secondary equity market can be further divided into two parts, a stock exchange and the over-the-counter market. A stock exchange is a central trading location where the shares of companies listed on the stock exchange are traded. OTC markets. The OTC market is a network of dealers who facilitate the trading of stocks bilaterally between two parties without a stock exchange acting as an intermediary. The OTC markets are not centralized and organized. Thus, they are easier to manipulate than stock exchange. For ECM, it's all for today, and now Keshina will talk about DCM. Thank you.
Hello everyone, as Paul mentioned, I'll be talking about DCM. DCM, also known as fixed income markets or a low-risk capital market, where investors or lenders in exchange for debt securities. These markets are also used by companies to finance themselves through debt, which helps diversify their funding. Next, we'll talk about a little why to invest in debt capital market. Debt securities provide an income stream as well as capital preservation for investors. The level of risk measured against the level of reward is something that all investors take into account when making investment decisions, and different investors have different risk tolerances. Some investors like the concept of high risk and seek out opportunities in the equity capital markets. However, for those looking for a lower risk fixed income investment, debt securities in the debt capital markets are usually more attractive. Next. Debt securities are promises that a company makes to lenders in exchange for funding, such as bonds, treasuries, money market instruments. They are generally offered with the addition of interest rates, which do not change and are dependent on the perceived ability of the borrower to repay their debt. For example, if the borrower does not seem to have the ability to repay, then the interest rate on a debt security will be higher. The opposite occurs if the borrower possesses such ability. Primary market and secondary market are the two major ways of acquiring debt securities. The primary market is where governments and companies directly issue their bonds, and the secondary market is where individuals who have already received their bond certificates go to resell the bond for either a higher or lower price, depending on supply and demand. Next. Here you'll see a classification, a list of bonds. Remember that bonds are a type of security sold by debt capital markets teams. Bonds consist of a wide range of different securities with different risk-return profiles and characteristics. Firstly, we have the investment-grade bonds, which make up most of the market and carry low risk and low interest rates. They are generally used to raise for funding working capital and regular business operations. Secondly, we have high-yield bonds, which are also known as the high-interest bonds. They are also the most dangerous types because they are generally issued by companies that may not meet their payment obligations. Thirdly, we have the government bonds. Government also sell bonds to investors to fund their operations, also known as treasuries. These are generally safer than corporate bonds, but the terms of these bonds are still reliant on how the market evaluates their creditworthiness. Generally speaking, however, government bonds are backed by the full faith of the government and are of high creditworthiness. Then we have the emerging market bonds, which are issued by developing countries, usually by their government. These countries generally have increased political and economic pressures, meaning that their credit ratings are usually lower, resulting in higher yield. Lastly, we have the municipal bonds. The US has the biggest market for these types of bonds. These are issued by a variety of government bodies, such as cities, school districts, and counties. Next. Lastly, I'll talk to you a little bit about the difference between debt capital market and equity capital market. As you all know, the major difference between DCM and ECM is the type of investing activity that occurs. In DCM, investors are lending money to companies, whereas in ECM, investors are purchasing a portion of ownership in a company. These two different investing activities yield two different levels of risk and rewards. With debt securities, investors are offered a fixed coupon rate, which is why the market is sometimes referred to as the fixed income market. And because of this, it has a lower return on investment when compared to equities. However, a higher expected return does not necessarily make equities a better market, because the potential for a higher return on investment is commonly associated with higher risk. Moreover, equity markets do not have consistent payments in the form of dividends, and the amount of dividend varies depending on how well a company is doing. Conversely, in debt markets, because the debt securities are promises to pay with interest attached, investors can expect their payment when it is due and in full. This makes debt less risky than equity, and the choice to invest in either one depends on the individual. Thank you. Now Paul will continue.
Thank you very much, Kashina. We will talk now about financial restructuring. And when I enter this topic, I want to ask yourself the question, when do you restructure something? So you restructure something when it's not working properly, right? So you can know that financial restructuring is a really stressful job because it's anti-cyclical. So all those IPOs, what we heard about the ECM, they are usually happening when the economy is booming, and financial restructuring is mostly made use of when the economy is crashing. And this can be seen by the word restructuring because we need to change something. So when we talk about restructuring, we can split up restructuring into corporate restructuring, which are the most consultants companies are doing. So they are here focusing on the balance sheet on the asset side. So they try to reduce costs. They look for opportunities where to sell parts of a business to reduce costs, or where to optimize a specific process. But when we now talk about financial restructuring, and financial restructuring is what's the part of an investment bank, we are looking on the liability side of a balance sheet. So here we want to negotiate new conditions with corporate banks. We are looking for debt to equity swaps. Where can we swap our debt to equity, or are there even opportunities to cut our debt completely? So this is that. And this here I put you just some names from banks which you should know, which are known for financial restructuring. So Lazard is especially focused on debtor advisory. So when you are the debtor and are getting into financial distress, Lazard is a very good address you should contact. And Julian Loki is for the creditor advisory. So when you are giving the money and now the company is getting into financial distress. And also the investment bank Macquarie is very well known for financial restructuring, because I also put them here, Goldman Sachs and Morgan Stanley, those bulge brackets everybody knows, they are not into financial restructuring. You don't associate them with financial restructuring. In fact, they don't focus on financial restructuring. And simply put, why are they not doing this? Because they can't. Why can't they do this? The answer is really easy, because of conflict of interests. So Goldman Sachs is also focusing on M&A, DCM and ECM markets. So just to give you an idea, let's make it really abstract as a really simplified example. So you are Goldman Sachs and I'm a business owner, and I now am in a financial distress situation. So I come to you, you are working for Goldman Sachs, and I show you my books, and you see, oh, you have a loan, which is from us, and you are now in financial distress, and you have also a loan from bank XYZ. So remember, you are working for Goldman Sachs. Which loan would you prioritize that I have to pay back? Of course, you would decide for Goldman Sachs. It's your employer. And in this situation, you are not really acting in my, as your client, in my interest. So you are in a conflict of interests. Also, maybe to go full circle, financial restructuring is often working closely with the M&A department, because there are also, of course, opportunities. When my business is now in a financial distress situation, maybe I say, okay, I don't know, or I don't have the liquidity to save it, so I sell it. And there's then of course, the cooperation with M&A and financial restructuring. And financial restructuring is really, really niche. When you remember the very first slide, I didn't put it on it because it's really, really niche. The people working there are highly specialized in financial restructuring, because you have those M&A questions, but you also have many, many legal questions. Okay, just think about insolvency law, all this kind of stuff comes on top of M&A. But this is the connection with financial restructuring and M&A as such. Genau. Then we see here now the next topic. SPAC. So SPAC stands for Special Purpose Acquisition Companies. This sounds maybe a little bit overwhelming, but just think about a SPAC as a company which is listed on the stock market. So they already had their IPO. They are already listed on the stock market, but they don't have any, and this is important, commercial business operations. They are. I show you. I made them here blank because they are also referred as a blank check company. They don't have any business operations, any commercial business operations, but they are listed on the stock market. This is also important. Okay, so let's go through the process. What's happening with SPACs? Then I think you will get the bigger picture, and then it's really easy to understand. So here you see the investors, and here you see the SPAC. So just a listed stock market listed company with no business activities. The investors now give money to the SPAC, and behind the SPAC, or what makes it so important, is this, the sponsor of the SPAC. Yeah, so the guy who owns the SPAC. Yeah, in this case I chose Mr. Ekman. So he is, what I want to show you is I don't invest into a business. I more or less invest into a person I know, and I trust my money to this person. So now his job is to find a company, which is referred to a target company. So this is a company, and let's say they want to go public, so they want to go to the stock market. They can use the usual way, or they use now the SPAC method, the SPAC process. So Mr. Ekman sees this company and says, okay, I want to invest in you. I want to make you public, so on the stock market. And they also want to go on the stock market. So they now will become one. Yeah? And this company will then later in the de-SPACing process will lose its name. So the name of this company will be taken. This is why this is gray. And as you can see, this is just a shell. Yeah, this is just the shell company. And this is what's really doing the business operations. SPAC companies are often referred as shell companies because they are just the structure. So I hope we can also clarify some questions later in the Q&A, but I think you see that you don't really invest when you invest in a SPAC. You don't invest in a company which is having proper business operations. You invest in a person, simply put, very simplified now, which finds a company and then acquires it, and then the company is public. We will now look more into detail. So we, as the investors, we give the SPAC with the sponsor, Mr. Ekman in this case, we give the SPAC our money. Okay, so now Mr. Ekman's job is to find a target company, and he has 24 months to do so. If he fails, we can also look what happens then. He fails, we get our money back, because our money during those 24 months is saved in an interest-bearing trust account. And if this project fails, if he doesn't find a target company, then we get our money back from this interest-bearing trust account. So maybe for what's also interesting, of course, he will find a company he wants to invest in, but we as investors also have voting rights. So we can also verify and say we are consenting with this decision as the investors, or we can also say, okay, no, please find another business. Of course, in reality, it's not that easy because we are many investors, but just so you can understand the bigger picture of SPACs. Okay, so this is the investment point of view. I think it's clear. So he has 24 months to find his target company. If he doesn't, we get our money back because it is put back here in this trust account. From a company point of view, okay, now let's this is also really interesting. Why would I do as a company? So you are now the CEOs of your company and you want to go on the stock market. We clarified already why you will do so. You have basically, you have many options, but they are really limited. So you could do direct listing without any intermediary. Spotify did this back in the days, but let's focus on the opportunity of a regular IPO. So for a regular IPO, we would do this, regulations. Here the BaFin we have when we are in Germany, the SEC controls us and checks our books. when we are in the USA and the FCA is for UK. Then we need to find underwriters, which are part of the investment banks. Then we need to do pitch meetings, and finally we can do our roadshow. And this usually happens in the last 2 weeks before we go public. Then we have then our roadshow, and there's then also the book building happening. So where the price is getting calculated, and this can happen. This can take 8 till 12 months. So quite a long time when I want to go public. So our alternative now as a company is to use the SPAC IPO. And this completely skips this roadshow here, by the way, at the end. And this only takes us 2 to 4 months. So the answer is it's much faster. It's so much faster to go public through SPACs because I go back now in the slides. I usually don't do this, but remember when I showed you this SPAC here is already on the stock market listed. So they basically just buy this, and now this is also listed on the stock market because they are acquired. What Philip told you the whole time in M&A, what he explained really well. So now we are also on the stock market, and this is exactly what we wanted to do. And now let's look at the SPAC point of view. For example, Mr. Chamat Palihapitiya, he had his SPAC company, and he was the sponsor, because he was the owner of the SPAC. And as the sponsor, you receive a promote. So you receive usually 20% of the founder shares at a really drastical discount. So what could happen when they acquired this company? They could buy the share as the initial shareholders for 0.002 cents, 0.002 cents. And the other public shareholders, for them, the other 80% were available, and they needed to pay $10 per share. So as you can see, he made a huge profit and a really nice income through the SPACs. I hope you can now grasp the basic idea and the basic concept what a SPAC is, why companies would choose a SPAC, how you can invest in a SPAC. And I also, because this presentation is going to the end now, I also want to say that there are, of course, risks. Because you invest, and I said this and I say it again, you invest in a person you trust. Be it the track record you can check of this person, the history, how profitable this person was before Mr. Eggman. Of course, he was really profitable, but you give your money to a person and not to a business with proper business operations. This is what I want to say. And SPACs are really, they are invented from the 90s. They are not a new thing, but they are really coming up. And in 2020, they were just booming because so many companies wanted to enter the stock market. So where's an opportunity, there's also a risk. So please don't just follow blindly into a person's opinion. Do your own research about the person, and you can use the track record for this very well. We will then now go over to our Q&A in case you have any questions, and we are more than happy to answer them.
Yes, perfect. Thank you very much for that amazing presentation. I will stop the recording.